Hey everyone, in recent videos, I've suggested the Federal Reserve may be done raising the overnight rate. Wall Street now predicts the likelihood that the Fed will not raise rates in November is greater than 90%, and it's more than 60% likely the Fed will keep rates flat at the December meeting. There are a few reasons Wall Street thinks the Fed has finished their rate hiking cycle. First, inflation has been on a steady decline. The headline rate was stable at 3.7% as of the last reading, while core inflation dropped 20 basis points to 4.1% last month. And while the inflation rate is still higher than the Federal Reserve would like to see, we likely haven't seen the full effects of the higher federal funds rates yet. But there are other forces in play. Over the course of the last couple weeks, two significant events have transpired. Kevin McCarthy was ousted as the Speaker of the House, and a conflict in the Middle East has erupted. Both of these events could have significant economic implications, and it's likely the Federal Reserve will want to wait and see how these new variables play out. But even though the Fed has likely concluded its cycle of rate increases, the commercial real estate sector could still face significant interest rate headwinds. Most real estate lending is based on the 10-year Treasury, and over the last 90 days, the 10-year has climbed 120 basis points to the upper 4% range. This in turn has pushed the single-family 30-year mortgage rate to the 8% range, driving home sales activity to its lowest level since 2010. In addition, commercial real estate lending rates have been on the rise. They now range between about 6.5% and 7.5%, depending on the property type, location, leverage, borrower strength, and a variety of other factors. But why have long-term rates been climbing so quickly? And what's the outlook for the coming months? There are numerous forces affecting long-term interest rates, but here are three significant drivers. First, the U.S. Treasury has been issuing more debt. In the last 2 quarters, the U.S. Treasury has issued $1.9 trillion in treasuries, which is triple the 10-year average issuance of $630 billion per 6-month cycle. This has been complicated by a reduction in demand for U.S. Treasuries, which leads me to the second driver of rising 10-year Treasury rates: reduced buy-side demand. China has been downscaling their U.S. Treasury holdings. Since the beginning of the year, China's U.S. Treasury balance has declined by about 7%, from $867 billion to $805 billion, and they have not been buying as much as they have in the past. Likewise, the Federal Reserve has reduced their acquisitions. Beginning in June last year, the Federal Reserve began its quantitative tightening program. Since then, the Fed's holdings of U.S. Treasuries has fallen by $843 billion, which is greater than China's entire holding of U.S. Treasuries. Granted, the Fed still holds $2.5 trillion more in Treasuries than they did prior to the pandemic. But as they bleed off their holdings, there are less Treasuries buyers, and that's putting upward pressure on rates. And rates could still push higher. On October 3rd, Kevin McCarthy was voted out as the Speaker of the House after he joined Democrats in extending the U.S. federal budget deadline to November 17. Because the fuse is so short and the House of Representatives doesn't have a speaker to drive the budget forward, getting to a resolution by November 17 could be very difficult. And if a budget isn't set, then the U.S. government could go through a shutdown. That would have a range of economic consequences, but it could also lead to a downgrade of the U.S. credit rating. And a credit downgrade could mean the U.S. government will have to pay higher interest rates to borrow money. That pushes up the rates on treasuries, which in turn pushes up commercial real estate lending rates. But higher rates are not a foregone conclusion. If the House of Representatives somehow averts a shutdown, that could help contain interest rate pressure. For the commercial real estate market, a rising 10-year Treasury could create additional headwinds. The market is still in the process of recalibrating to the Fed's rate hikes, and further rate increases could widen the buyer-seller expectation gap. Even if the Federal Reserve is done raising the overnight rate, the 10-year, upon which most commercial real estate lending is based, could continue to climb. Ultimately, commercial real estate investors need to focus on the long-term outlook. Even if rates rise over the short term, it's unlikely they'll remain elevated over the long term. In addition, commercial real estate space demand should strengthen when the U.S. enters the next growth cycle. And that's why commercial real estate investors need to take a long-term perspective and keep their eyes on the horizon.